Well, we're very honored to have Valérie speak to us today. The title is intriguing, by the way. Do they add up? Question mark. Using macro counterfactuals to assess micro estimates and macro models. Thank you for being, it's so nice you're around. Too.
Okay,
So thank you, Valérie.
I'm absolutely delighted to be here. I was, getting my slides done at the last minute, and I said, "Oh, what is this?" And then I remember the first seminar I gave at Stanford as a graduate student. In the middle of the night, I was running off handouts at Hoover because my office was here. So I said, "Oh, nothing much has changed." All right. So this is actually an outgrowth of a keynote speech I gave in April for the Royal Economic Society and the Scottish Economic Society's joint meeting for the 500th birthday of Adam Smith at University of Glasgow. And they also wanted a paper for the Economics Journal. So my co-authors and I have been working on that paper. It's almost done, not quite. I also gave this as a keynote at the Society for Economic Dynamics in Cartagena. But anyway, it's much expanded now. And so then that's what I'll present. So let me just take a step back and sort of think of the big picture. So I don't know if you recall, Angus and Pischke had their Journal of Economic Perspectives piece in 2010, where they extolled the virtues of the credibility revolution and empirical economics, talked about all of the great new techniques that applied microeconomists were using, and were producing much more credible estimates. However, they scolded the macroeconomists and the industrial organization economists for not adopting these techniques when these were clearly the right way to go. So they claimed that we were slow to adopt them. And indeed, at that time, the dominant macro methods were either time series, often structural VARs, or quantitative DSGE models. Those were the main things. There were a few macroeconomists for many decades that use sort of natural experiments, which was an applied micro, one of these techniques, to estimate parameters or causal effects. So, of course, people have used natural experiments such as wars, also hyperinflations, timing of social security checks, a variety of things like that.
Why do you call wars natural experiments?
Well, because it will lead to changes in government spending that are typically not associated with what's going on in the economy at the moment. And as you know, that's a big part of my research is making that case.
I mean, just from knowing history, it strikes me as untenable.
Well, we could talk about that later, okay? Because this is not actually using that identification in this particular talk. Now, the recent renaissance in macro fiscal research, as well as other macro research, such as the effects of housing prices on consumption, has included the widespread use of applied micro methods. So these methods did diffuse in macro in the years since that 2010 paper. So there are many new natural experiments to estimate household MPCs, Bartik instruments to estimate regional fiscal multipliers and panel data, and many other examples.
You qualify them as quasi-natural?
Quasi, that's fine if you want to call them.
What does that mean?
Or unnatural experiment, any of those
What's
things.
quasi mean?
It's not a tsunami all the time.
Oh, that's fine.
Putatively, it would cover both what everybody's trying to say at a minimum. It's a minimum, okay?
Okay.
All right. Can I make one comment?
Sure, yes, please.
There's a little bit of a counter revolution in econometrics that's led by Angus Deaton,
Yes.
that the claims being made for these methods are exaggerated and the
Exactly.
assumptions necessary for these things to hold are quite substantial.
Well, you will see in the 3 illustrations in this talk that I'm going to make the same point.
Okay, yeah, just to get my
I'm just
to get my views on the table, I think they're an important quiver, but
yeah.
just every paper that says we've estimated the causal effect of this on that.
Exactly.
By the way, often in applied micro, when you wouldn't care what the effect of this on that is, but it's they claim it's well identified. But just as a general issue, this isn't settled doctrine in econometrics, despite this.
No, I know. There are a number who do think that This just gives you the credit, the estimate and
Better
you
than
should run
OLS
with that.
regressions for sure. I
Yes.
agree with that.
Yes. Well, depending on what you want to estimate, sometimes
Yeah.
the OLS
Yeah.
might actually give you something better. So in my 2019 Journal of Economic Perspectives paper, I talked about some of the limitations, which is that one of the things we found out even back in 2011, which is a lot of these micro estimates, such as using cross-state or cross-province variation, only gives you relative effects, all right? And that this is also the same case with Otter, Dorn, and Hansen. They could only give you relative effects. And in order to talk about the macro implications, turns out you actually need a macro model to do that, all right? So that's why in that piece I said there's no applied micro free lunch for macroeconomists. If you want to answer macro questions, you either have to use macro data as your principal estimate, or if you use these applied micro techniques, you've got to pair it with a macro model in order to get the macro answer. All right. Now, the other caveat is, often, and I certainly found this in surveying the estimates, you can find very different answers from the question that the answers you get, say, using just a DSGE model that's calibrated or estimated or aggregate time series versus what you get when you take some applied micro estimate and use some model to figure out what the macro answer is. So what's the theme of this talk? What I want to argue here is that we could exploit this micro-macro confluence to take the credibility revolution one step further. And in particular, what I want to argue here is that we should use what I'm going to call macro counterfactuals that are implied by the micro estimates to assess the plausibility. All right, so I want to get the new idea of plausibility of the micro estimates and macro models. All right, so why is this tool useful? As I said before, micro estimates and macro aggregates don't always agree. Often researchers who just need an estimate to put in their model or policymakers are faced with a bewildering array of estimates, and some might be tempted to use the one that serves their purposes best rather than because one seems to be on a stronger
May
basis.
just be tempted to do that.
Well, I'm being nice.
You might delete my.
Following up on Michael, so there's also an issue of exogeneity and magnitudes of shocks.
Yes.
So part of the credibility revolution, and when I think about a macro model, I don't know what's really endogenous, exogenous. So is this part of your
yes
argument?
Exactly. So the other nice thing about this tool is suppose, and I'll show you how you create a counterfactual, suppose that it just doesn't look plausible. Well, then that helps you look at maybe which estimates or which models need more scrutiny, okay? So in all of the reviews I've done of various types of fiscal multipliers, infrastructure, and that, I've gone through a lot of replication files. It takes a long time to delve into the details, and often the devil is in the details, all right? We all thought that instruments were so important, but it turns out other things like just the way you take your estimates and calculate a multiplier really affects what the multiplier is. So what's nice here is that it says, oh, we should look more at this estimate because there's something that's not adding up. Or we should look more at this model that translates that estimate because something's not adding up. And then what we found so far, because we have our previous paper and then this one, is that the search for reconciliation is often illuminating.
How often are we able to replicate based on public available documents?
Most of the time, well, the fiscal people are very careful with the replication files, so I've had good luck with that. Oh, okay.
When you say search for reconciliation, you mean that the micro model, the micro data may be wrong, but also the macro model.
And also the macro model, exactly. It could be, and that's why I'm going to give you 3 illustrations because we get a different answer in each one. All right, so let's go back just to give you some motivation about this micro-macro tension concerning the 2008 US rebates. And I had this in here even when you're not present. Marty Feldstein and John Taylor looked at the aggregate data in 2008, after those rebates were given out over the course of spring and summer, and they did simple analysis, and they looked at numbers like this. This is just the revised data. So the the green line is real disposable income, and you can just see that rebate. And the red line is when 50% of the rebate was given out in May 2008. And then you look at the consumption expenditure line, and it has a little bump in it, but there's no spike there. And they concluded that the marginal propensity to consume, MPC for short, for the 2008 rebate was low. Okay, so that seemed really clear. It was just obvious in the data. Now, a few years later, Jonathan Parker and his co-authors produced some micro MPC estimates out of that rebate. It was just wonderfully entrepreneurial and foresight on their part to add rebate questions to the Consumer Expenditure Survey, the CEX, and the Nielsen Household Survey. All right. It was a great natural experiment because the rebates were distributed over time based on the last 2 digits of the Social Security number. It was basically randomized. They used the then state-of-the-art applied micro methods, difference and difference, which is basically OLS. You know, you have your fixed effects. They estimated very high MPCs out of the 2008 rebate, 0.5 to 0.9 on total consumption. The majority of the spending was on motor vehicles. When I saw the first working paper version, I said, wait a minute, how can this be? I said, you know, these guys do great empirical work, but how can this be consistent with what John Taylor and Marty Feldstein had found? Now, policy, because of the credibility revolution or because they wanted to pick estimates that were convenient, policymakers and most researchers believed the micro estimates and ignored the simple macro analysis. So what are the aggregate implications of Parker et al.'s estimates? So a few years after the working paper versions came out, Matthew Shapiro showed me a calculation that he and his co-authors had done. And it ended up in the last part of a 50-page paper in a little table, kind of downplayed, table 14, okay? They looked at what the implied induced spending was by the rebate if you took the Parker et al. Estimates and multiply it by the rebate. And then it was in this table, and they kind of averaged it over the quarter, you know, just the induced spending. Well, what I actually did in a discussion years ago, and then what we do in our 2008 paper, we say, okay, let's create a counterfactual. Let's take that induced spending and subtract it from the actual and see what it implies would have happened had there been no rebate. Now, this is a simple micro accounting exercise because it doesn't take into account general equilibrium effects or any effects on the auto industry. It's just a simple accounting exercise. So when we do that, the counterfactual implies that spending on new motor vehicles, remember that was their big MPC, would have dropped 87% in the summer of 2008. So I have a number of papers on the auto industry. This has never happened. Did not have to happen after Lehman. I don't even think it happened during the Great Depression. All right, so just clearly something's not adding up there. So what are the key ingredients to a macro counterfactual plausibility analysis? First, you need micro or subregional estimates of key parameters relevant for macro effects. So for example, the household MPCs I just talked about, fresh labor supply elasticities, firm level supply elasticities, or say local city multipliers or state multipliers. Any of those sorts of things are using those applied micro types of methods. You need a policy or event that is big enough to be visible in the aggregate data, okay? Now, those estimates typically are from a study, the micro estimates that happened during that event, but that's not necessary. You could take micro estimates from another period, and as long as there's enough similarities, say it's temporary, you could also apply it to a policy event in a different period. You also need a macro model that translates the micro or subregional estimates to dynamic general equilibrium effects, or We focus on macro, but you could also do this at the industry level. So for example, you could see if something's big relative to the industry, given some, say, estimate of firm supply. And then you need a narrative analysis of the time period surrounding the policy or event, because you need to make the case for whether the macro counterfactual is plausible or not. All right. This often requires auxiliary evidence, forecasting equations, lots of reading about what was going on in the time period. Okay, so I'm going to illustrate this method in 3 cases. First, I'm going to look at 2 on the micro MPC case. I'll focus more on the 2001 case in this paper, in this talk. The 2008, I'll summarize some of the key findings because it's useful to compare the different sorts of reconciliations, but that's mostly dealt with in our separate paper. And then also some macro implications of state level multiplier estimates.
Now, in your discussion of the literature, you didn't mention a paper by a couple of CBO economists, Michelangeli and somebody, that was about the US, the 2008 case. I think that was the 2008 case. And what they showed is that there was no such thing as a macro MPC, basically, because they had data broken out by income group, by how many assets they had, because so they had highly disaggregated kind of data where they could do this, and some groups had high MPCs, some people had low MPCs.
That's okay.
So you know, that was informative, and from policy point of view, maybe I care about the people who have high MPCs, and then just the money that I waste on the low MPC people. Well, okay, that's just a waste. But, you know, it's a cost of getting money to the high MPC people.
Right.
So, but now, wait, you didn't mention that study. Doesn't that fit into your?
Okay, I have not seen that particular one, but I think you'll see that what we're doing is
in the AEJ. So,
AEJ.
Yeah, AEJ macro. So, unless those journals are not.
No. That just had not seen that one.
Okay.
Okay. What is their conclusion about the aggregate effects?
Well, they kind of get they probably got the average effect to be what the macro say, but the thing is that the issues really aren't, the key issues really aren't summarized well by the aggregate.
Well, wait till I get to the model and see what you think, because we are going to have some heterogeneity there, and then we're going to talk about
that's what that was.
that heterogeneity, but then how that turns into what we call a GE MPC. But I'll get to that soon.
You have a Hank model in some case.
Yes, you could do. Yeah. All right. So let me just give you, a little bit of background. There's the Johnson, Park, and Soule list, JPS for short, which studied the 2001 rebates. There's the Parker et al. PSJM that studied the 2008 rebates, also Broda and Parker. And I already told you this, each study relied on all these great natural experiment methods and new data creation. Okay, their estimating framework is straight out of the traditional permanent income life cycle test, okay, where people take a change in consumer expenditure, so this is at the household level I, and they have month fixed effects for each month. They have some control variables such as age and change of household size. And then they have this rebate variable, which can take the form of the dollar amount, an indicator for receipt, or the dollar amount instrumented with the indicator. So they run it several ways. And the idea is that is for the most part exogenous, because the timing is based on the last 2 digits of your social security number, although it does cut out at several income levels, but I won't get into that detail here. All right, the 2001 rebate. So this was the Bush 10-year tax cuts that were passed in early June 2001. The checks were either $300 or $600, depending on if it was joint or married filing. Single or married filing jointly. Went to 92 million households. The total rebates were 38 billion, which was about 6% of monthly disposable income. So here's a graph of the 2001 case. Disposable income is the green line. The blue is the rebate. The rebate was big. It happened over several months, and you can definitely see it in the aggregate data if you look at that disposable income line. Now, when they do their estimates, so first let me talk about their baseline estimates, which just looks at the contemporary effects within basically a quarter. So people are only interviewed, every 3 months, and so they often take just the average of the 3 months over the quarter. They construct something they call a non-durable spending category based on Anna Maria Lusardi's sort of strict kinds of things and broader classifications. And we spent a lot of time looking through these categories. It's actually a mix of some non-durable goods, some services, and even some durable goods. So jewelry and medical equipment happen to be in there. Now, their instrumental variables estimates produce a marginal propensity to consume of 0.375 with standard error that's reasonably low, and that's based on a quarter-to-quarter difference in spending. Now, their preliminary analysis finds a statistically insignificant MPC on total consumption that is less than the MPCs on their subcategories. They attribute that anomaly to noise induced by durable expenditures. Thus, they say they're going to ignore durables and total consumption and just focus on the very strict non-durables and this category. All right, so remember that because that's going to be key. All right, so they also look at dynamic estimates allowing lag rebate to have an effect on the current 3 months of consumption. And when they estimate this, they get a contemporaneous effect of 0.386, an additional lagged effect of 0.273 for a cumulative 6-month effect of 0.66. All right, very, very high. All right, so how do we create the counterfactual? So first, let me do the micro, just using the micro stuff with no general equilibrium effects. All right, we calculate the induced spending using their MPC estimate of 0.375. We assume it's spread evenly across the 3 months of the quarter. So that's what the spending is. For the 6-month estimates, we're just doing the same thing, but then allowing that additional effect from the rebate, from 3 to 5 months ago. So then our counterfactual is the actual aggregate non-durable consumption using their category minus induced spending. So here's what we get. So this is for 2001 through early 2002, just so that you can kind of see the whole picture. The black is the data for their definition of non-durables. The blue line is when we just take into account the contemporaneous 3-month effect. That's with the micro MPC of 0.38. The purple line is 0.66. All right, so this is based on the micro estimates, no general equilibrium effects. All right, so a couple of comments on that. First of all, you get what we also saw in our 2008 paper, what you saw more frequently, these sharp V shapes. Okay, and of course, even more so when you allow that other effect that takes longer to get back. Now, 9/11, that's there in that September one. And you can see even the actual data go down there, but it goes down quite a bit here. Likely had some effect on this. We would have expected that decline, particularly since airline spending is one of the categories. But there were already declines in August, and we're going to, oh good, Tim knows this because we read a whole bunch of the things. So there was something else going on. And most of the analyses were saying there was a quick recovery, rebound of spending from 9/11. Remember, President Bush said, go out and spend. And then there were all these automobile incentives. That was actually durables. But we're going to analyze this more carefully after I show you the general equilibrium counterfactual. Because, as I say, we're not taking into account general equilibrium forces. So let's think about the macro counterfactual.
Well, you're also ignoring the fact that tax rates were reduced. So basically, by the experiment where you only focus on the rebates ignores is like an income effect, but ignores the price effects that were also
yes, but
put in place.
In a standard new Keynesian model, yeah, you're not going to get a lot because there's so much stickiness.
I believe in a standard new Keynesian
well,
model
because
for investment decisions and saving decisions.
Okay, yes. So So you've lit onto something else that we're going to talk about, which is people, a lot of the literature has treated this as a temporary rebate but in fact, it was a 10-year tax cut. And if households can be forward-looking, but not completely Ricardian in that they don't take into account the government's budget constraint, and you would expect a higher MPC. But let me leave that till a little bit later.
I can ask her to.
Yeah.
There are two other issues I see here. So one is that depending on your expectations of the persistence of the shock, you will behave differently.
Yes.
But even econometrically speaking, these are linear distributive lag models. If I take even the simple growth model, business cycle version,
Mhm.
and I input a shock, well, depending on the horizons at which the shock itself manifests, I will have a different impulse response.
Oh, yeah.
Cumulative.
Yeah.
I mean, locally speaking, it would be differently nonlinear in a way that the typical regressions we run cannot possibly keep
Right.
up. So if I even extrapolate one period ahead, because that's what they do, I think they have one lag only.
Yes.
It's not exactly interpretable vis-a-vis any model that we know.
Yeah. Because first, it's all relative sorts of things. And we actually
Super
talk
linear.
about those
And
issues.
all our impulse response is actually reabsorbed
Yeah.
super nonlinearly.
They're not,
That's what I'm saying.
yeah, except we actually don't
There's a
find that in our model. We do things both using shooting algorithms and log linearization, and the results are really similar, given the, the particular rebate check was more temporary, and that's where the estimates are coming from.
Because
You only
would
got it
think
once.
From
Yeah.
a standard first-year model,
Yeah.
that if I were to look at the elasticity of response, it's certainly not time
Yeah.
constant.
Yeah, but it's not that different, we found. Okay. So what we do is construct a medium scale, two good, two agent New Keynesian model. All right, so these are the kinds of models that a lot of policy institutes are using. And these are the ones that they say, give us big multipliers. All right, so we're going to use that model, but we're going to
But
show.
Public finance guys have been using much less aggregated models for decades. I mean, like for example, Dale Jorgensen has a multi-sector model.
Ken,
So
you'll see. So, it's my fault that we couldn't get the paper out to
yeah,
you, because we're really careful. What we do in our model, as you'll see, is we're going to calibrate the parameters such that if you take our model and generate data from it, Jonathan Parker will get his same estimates. And then you can see what's going on at the aggregate. So what matters is that we're capturing those micro estimates and then what that says for the aggregate response.
Well, if I could
Yeah.
just raise a question or a comment. At a conceptual mathematical level, we all confront this issue of aggregation, exact
Yes.
aggregation. There's theorems about that going back to De Bruyne and Sonnenschein that are lovely, and there are attempts to deal with Hank models or a step forward, because Euler equations don't aggregate, et cetera. But it seems to me that this is a valuable exercise, but kind of the first question you should be asking is, do the macro estimates or micro estimates even bound the true sample mean, for example? Things like that. And I'm wondering,
Well, so
because you're making a bridge from the micro to the macro, but is the bridge sufficient, I guess? If we wonder what the truth is on MPCs or something, some abstract thing called the truth, or we have some probabilistic thing going on, we're trying to get an unbiased or a consistent estimate of the sample mean, and we get these vastly different things. Could it be larger than Parker? Could it be smaller than Marty and John?
well,
And do we know anything about that, or we should take these two numbers and try to go back and forth?
that's actually the point of just looking at the aggregate data and thinking about the plausibility of any estimate that you put in there for how big that effect could have been of that noticeable policy during that period.
Okay, I get the plausibility idea, but going back to different groups, et cetera, there's a set of potential MPCs in a if we disaggregate by income, education,
Yeah.
location, et cetera, et cetera. And maybe we get some estimates of each, but those are just, they're one draw of a sample.
Right.
And
Yeah.
so the basic question I'm trying to grapple with is what you're doing. I think what you're doing is very valuable and useful. I should start there. I don't mean to suggest it isn't, but is it informing about anything about aggregation from micro to macro in general or not? And maybe it's just not possible. I mean, you know, there's the JEL survey by Blundell and Stoker, for example. But you know, it's kind of a permanently vexing problem that people have been chipping away at, and you're adding an important part to this.
Yeah.
But should I just focus on this, or should I be thinking more broadly about it from what you're doing? Should I be?
What Michael is talking about is called uncertainty quantification
Right.
in the computational engineering literature,
Mhm.
and it's it's growing in its use, and that is because even people who build nuclear bombs aren't sure about the parameters of the bombs, and so they develop these uncertainty quantification techniques. Now, in economics, doing that is forbidden. So that's the problem.
Well,
What?
in any event, maybe the answer is this isn't, you know,
Yeah.
that's a broader
No,
and more complex goal that you're tackling right here. So that's
Yeah.
fine.
I mean,
I'm just trying to understand
Right.
what I'm supposed to make of this.
So we are not focused on the kinds of aggregation theorems that you're talking about. So for example, you know, one of the things is because we wanted our model to be transparent, so we just do the 2-agent model. We've looked at you know, some heterogeneous agent sorts of things, and we find that the counterfactuals become even more implausible, but that's just for one particular variation on a heterogeneous agent model, since there can be so many.
That's fine.
But you're right. I mean, we're not, again, we're macroeconomists, and even though we now do heterogeneous agent models, we don't do things at the level of detail that public finance people do. So I think that's a really interesting question that I would want to think about more. But I wonder to what extent this technique that we're trying to use here could be extended to the richer public finance sorts of aggregation questions.
There are lots
No,
of applications
absolutely.
of this, but anybody who works with
Yeah.
Micro data,
Right.
survey data, for example, census data, whatever it happens to be, is just immediately struck by the immense heterogeneity.
Oh, yeah.
And including the heterogeneity among observationally equivalent when we condition on all of our stuff.
Right.
And it's not just sample variation, it's clear there's something else going on.
Right.
And Michael, can I ask you, you're
Mhm.
asking also about model identifiability, sample coverage, and model uncertainty, which brings to the questions, which I think is super fundamental. Am I right? That are we identifying anything that is interpretable via macro model from these micro exercises?
That's also a quick. I think that I think it probably is, but it's a question of how you interpret it and how it feeds into the model and exactly what your parameter means.
Exactly.
Yeah, I mean, and so that's why with this simple system that we're using here, we're trying to get at that to some extent.
Because consumptor
Yeah.
elasticity responses are not parameters alone.
Right. No, absolutely. So we just take basically an off-the-shelf kind of model. Basically, we just take, in my infrastructure paper, I had extended Jordi Gali's et al.'s model to update a few things, and I had infrastructure spending at that time. But then we just take that, it has, you know, the bells and whistles of a medium scale new Keynesian model. It has the sticky wages and prices, variable utilization of capital, investment adjustment costs. We need two goods, though. Usually those models have only one good. We need two goods in this case because the JPS categories assume that all spending is focused on their non-durable category, which is only 53% of total personal consumption expenditures. so we add that second good. We use a Taylor rule, lump sum taxes, and we assume they respond to debt with a 12-month lag, just so that we don't have any taxes changing. And then,
Wait, so
yes,
you're assuming,
we're assuming, yes, it's this.
which of course is totally counterfactual. There, because the deficit, the debt level grew substantially during the early 2000s.
Yes.
So
Well, the key is that in 2001, they believe that lump sum taxes will be raised later.
that they believe that lump sum taxes were going to be raised
Yeah,
later. I
it's a
don't think so.
simple-
Ask Glenn Hubbard. I don't think he dare say that we believe lump sum taxes were going to be raised in the future.
The consumers in our model, that's all that they have to assume.
I mean, you have
Well-
to make some assumption.
Yes. But I don't think, so let's see, if we also put in, but your point about tax rates, because tax rates definitely were
And debt
changing.
level, you're assuming that basically the debt level is stable, and it certainly
Yeah.
wasn't.
No,
And nobody expected it, I don't think.
yeah, but it's really hard to solve a model and make projections when you have government
No,
insolvency.
it's not that hard. Yeah, I mean, the thing is that you can't do log linearization because it's a non-stationary thing.
Yeah,
But solving non-stationary models is easy nowadays.
w-
Not when you're a graduate student, but things have advanced.
I mean, we do use a shooting algorithm, but what matters is what was going on in 2001. How did people respond to this? And do we think it stimulated aggregate consumption, given those MPC estimates? That's the basic thing. So it's much more short
But
term than the
you
usual
could
long
check
term
the
you're looking at.
sensitivity of your results.
Yeah, we
To
could put in-
whatever these assumptions are about lump sum
Yeah.
taxes and lag.
Yeah, it's, and-
To show that, you see, that's,
Do you prefer people expect an increase in marginal tax rates in the future, or do
Well,
you want an increase in default probability? 'Cause
it's
you gotta
marginal
have
tax.
some-
We have never had a
gotta add
US
up.
default yet, right?
There's-
Okay, so
Revolutionary War.
Eventually, they're gonna tax
after the
their
Revolutionary.
they didn't pay everything.
Not, that was before the Constitution.
Okay, well, you said in the US, it was still,
Well,
So
that,
basically,
yeah.
if you're gonna postpone the tax hike,
yeah,
the present discounted value of anything further in the future will be less, so it'll have less
right,
impact.
right.
Yeah, but you could test that.
Well, wait, though, it's gotta be present discounted value of revenue has to offset the present discounted value of the transfer, so isn't
Yeah.
it the same? Like if instead it's 10 years from now, there's gonna be lump
I have
sum
this
taxes,
argument
which
with
have to
Paul
be
all the
bigger.
time. It depends
We
on what,
discount them.
it depends on what consumers are discounting at.
There could be heterogeneity in the discount, right?
Absolutely, and consumers gonna be looking after tax. Okay,
Yeah.
so.
The-
government-
the
the
re-
government-
Time those lump sum taxes are paid,
The government collects the.
it'll be I'll be dead and other people are gonna pay them.
That's fine.
So.
You'll see, okay, the reason we do this is because it matters for the hand-to-mouth households. And in fact, I didn't have such a lag in my infrastructure paper when I presented it virtually at Stanford. Adrian O'Clair made a point, oh, but that's going to have an effect. And I said, oh, I should have realized that. It was too late for that one. But so then that's why we have this delay, so you don't start raising the taxes right away during those sorts of things. Okay.
Yes, but
Yeah.
the second good, is it a durable good or is it?
No, in our 2008, it is a durable good. In this case, it is another non-durable. And it's actually going to be, there's going to be perfect substitutability in production between the two goods. So the relative prices are going to be constant. And so it just makes sure that we're scaling things properly.
Now, macroeconomists usually write down models that are closed economies.
Yes, ours
Now,
is
a
closed
closed
economy
economy
too.
Okay, so which is, and I thought after Feldstein's testimony as chairman of the council being so disastrously wrong in the early 80s, this is before you were paying attention to things. I would think that after that, people would learn that the closed economy assumption, which is what he used when he said the Reagan deficits would explode interest rates. I mean, it's wrong.
Yes.
And so this business of a closed economy is just
Yeah,
false
we-
and importantly false.
So we don't have big changes in interest rates as a result of this stimulus that we're looking at.
But that.
Because these are,
Do you even have a capital market here?
yes, we do.
Okay.
Yes, we do.
Why don't you continue?
Okay. And so then we simulate the response of consumption to the rebate. So we calibrate, so that's what's so handy with this model. We can calibrate the fraction of hand-to-mouth households to exactly match that micro MPC that you would get from microdata generated from our model. Okay, so just a few things. Pretty standard utility function, although I'm sure Ken will have something to argue with. It's two types of consumption. Also hours. So we have non-durable consumptions defined by JPS, and then C2 is all other consumption. S1 is the share of the JPS non-durable expenditure and total consumption. We have elasticity of substitution across the consumption goods. It turns out not to matter, and a Frisch elasticity. And then, as is usual with the medium scale New Keynesian model, labor supply is not chosen by the household, instead by this fiction of a union. And that's just to get people off their labor supply curves. All right. Optimizing household constraints, very standard. Households save in the form of a nominal bond. There's a gross nominal interest rate R. There's a gross inflation rate. W is the real wage. Their expenditures are on the two consumption goods. And then there are, actually T0 is not transfers. T0 is taxes. But if it's negative, then it's transfers. And then profits is real income.
So there are no distortionary taxes.
There are no distortionary taxes. You know, we could, that's an interesting point, given that this was not just a tax. I don't think it will matter, but it's very easy for us to look at it. Yeah.
Back in the 70s and 80s, people were writing papers about how inflation, since the tax system is nominal,
Yes.
that
No,
inflation
I know.
has a real impact.
That's for
even
sure.
even if you have the standard money neutrality. So now
Yeah.
that's one easy thing. And basically, by the way, the thing is that inflation is also going to affect the local eigenvalues when you log linearize this. I've shown this in a paper years ago.
Yes,
So
but
the thing is that the dynamics are going to be affected.
Valérie continue.
Yeah, I mean, this is a small thing. So for simplicity right now, let's just think of this as a temporary tax rebate, which is the way people were doing. You don't get much inflation. These effects are pretty second order. Okay.
There's no constraint on asset holdings.
On asset holdings, no. Okay. So the hand-to-mouth households, in contrast to the optimizers, follow this hand-to-mouth rule. In steady state, we assume that they had the same after-tax income as optimizing households. What we then do in order to exactly match, Jonathan Parker's estimates, we assume instead of making them consume everything in the first month, we're going to spread it over the 3 months. And so we have these dynamic marginal propensities to consume. And then whatever they don't consume initially, we assume that they just get the same rate of return of what's sitting in their bank account. And JPS assumed that the MPC on other consumption is 0. So we assume that for these hand-to-mouth consumers. All right. So we can exactly match what kind of estimates they're getting. We calibrate to a monthly frequency. As I said already, we spread equally over the 3 months. The baseline for the contemporaneous is that 0.375 or 0.66 for that 6-month specification. And as I mentioned before, the elasticity of substitution doesn't matter because relative prices don't change. All right, so what do we get? So in the left panel, panel A is the micro that I already showed you. What happens when we start taking into account general equilibrium effects in this new Keynesian model? Well, those V shapes become even more pronounced. All right, so those declines are more, which shouldn't be a surprise because new Keynesian models are rigged to get you amplification. All right, so any of those sort of micro MPCs are being amplified by the standard tank model. And here we just have the too good tank model. Now, some comments on this. All right. As I said, the V shapes are more pronounced. Now, we define in our 2008 paper, we defined a micro MPC, which is the kind of thing people estimate households. And then we talk about what we call a GE MPC, which is the general equilibrium response of consumption to a rebate. All right. So that's going to be equal to the micro plus any amplification or dampening. All right. Now, if you have a closed economy And if you have a temporary stimulus, then in general, the GE MPC will be very close to the output multiplier because investment's not going to be changing. There are no net exports, so it's the same as a multiplier. Now, if the micro MPC is that 0.375, here we just rounded to 0.38, the GE is going to be 0.5. But as that micro MPC climbs, because of nonlinearities, that GE multiplier becomes even bigger. In this case, the 0.66 turns into a 1.33. So is that counterfactual decline plausible? Remember, this is a really important step in our method. So we do comparisons to other declines historically in this category. Our GE counterfactual implies a 3-month decline of 1.5%. The only bigger declines that you can see in the data that go back to 1959, this is the monthly data, are during COVID. And then this decline after this weird spike in 1960, we spent so much time trying to figure out why there was a spike. We still can't figure it out. But anyway, so it was just sort of something with the data. That's the only other time it was that big. Now, 9/11 certainly accounts for some of the spending dip in September 2001. But as I mentioned, observers such as Blue Chip and others made numerous statements before 9/11. In fact, some things published on the 10th of September, they were calling the rebate a non-event because it wasn't showing up in spending in August. That rebate was paid out from late July through late September, okay? So other things that we do, we'd also done this in our 2008 paper. We say, let's do our own forecasting model, behaving as though we're doing sort of real-time stuff. So we have a monthly forecasting model that uses the JPS category of consumption, disposable income, consumption price deflator, gas prices, and the Gilchrist-Zagrajcek excess bond premium. We find that those variables, we had tried all these other variables in 2008, are just very good at forecasting consumption. But once you put those in, Michigan survey doesn't matter, all of those sorts of things. So what we call the contemporary model uses, information they had since May 2001. And what we say is it assumes that no one realized that the economy was already in recession because the recession had started a few months before. The pessimistic model, where we can get a more pessimistic forecast, assumes that the economy was already in recession and then also takes gas prices as exogenous rather than responding endogenously. This actually significantly reduces the forecast path, particularly since the 2001 recession was much more mild than the average recession. So putting that recession dummy in there really, lowers that path.
Can I ask a
Yeah.
specific question? For the expectational type of specification that you find more plausible, what margin of response ceteris paribus would need to be shut down for the macro?
Wait, what margin of response?
Would need to be shut down for the macro model to get closer to the macro model.
So other thing, so for example, there's the usual levers. So for example, we could change the parameters on the Taylor rule. We could make it harder to vary utilization. We can do things with labor, all of the usual.
But that's not, I see.
Yeah, but I'll tell you why we didn't pursue that when I get to the estimates. Okay.
This is consumption.
So this is consumption, the JPS category of consumption. The black line is still the actual. The, let's remember, the purple line is that micro counterfactual. The green line is the macro counterfactual. So you can see that amplification there. This is just for the contemporaneous case because otherwise the graph gets too messy. The blue line is the contemporaneous forecast if you don't know you're in a recession, all right? Generally, you're going to forecast an increase in consumption because consumption almost always increases. But the pessimistic forecast that just takes into account that they're in a recession gives you the red line, right? Now notice that the red line is not that different from the black line, but it's definitely quite a bit above those two counterfactuals that we have there, the micro and the macro. So we consider those V shapes implausible. So the question is how to reconcile micro and macro. And this is a case where we say, okay, let's go into more details in the data. And there are a lot of details in these data. So the reconciliation with either smaller micro MPCs or GE dampening, general equilibrium dampening, rather than amplification. All right, so we examine the micro MPCs based on the CEX data again. All right. And we also, this just lists what you could do with the tank model, but you'll see once we've looked at these data, we figure we don't need to mess around with the model. All right. So the JPS non-durables categories, remember, it includes many non-durable services and some durables, but it's only 61% of the Bureau of Economic Analysis sum of non-durable goods plus services. So let's compare the MPC for their categories versus the BEA categories. So we go to the replication files, but of course we have to draw the CX data ourselves. So we quite close, not a perfect reproduction, but very close to what they get. So first look at the JPS definitions. So this is looking at the rebate, the MPC out of the rebate, strict non-durables, which was more like food and those sorts of things, and then the non-durables. So look mostly at the non-durables category. So they got 0.375, we get 0.32, but that's pretty similar. But if we instead say, oh, well, let's look at the BEA definitions, non-durable goods and services, look at those as separate categories, we're getting quantitative and statistical zeros. 0.06 on the non-durable goods, 0.03 on the services. When we look at total consumption, we find what JPS mentioned in the footnote is if you look at total consumption in the CEX, you get an MPC of 0. All right. Why is that happening? Because it turns out there are a bunch of categories with negative and sometimes statistically significant MPCs. So, maybe there was some shifting around, but you can't just set it equal to 0 for some categories and then claim a significant MPC for the categories that are getting you the nice positive numbers. So,
an example of assumptions producing as a result.
Yeah, well, you could see they had this beautiful natural experiment, new data were created, and sometimes no matter how much you torture, the data just doesn't want to speak. These data didn't want to speak, I think, was one of the issues.
They did speak.
Well,
and they didn't want to listen.
Whatever. Yeah, sometimes the data are trying to tell you things. I've had that case where I said, no, don't tell me that. Eventually you listen.
I don't understand.
Yeah.
Were JPS cherry picking here? Were they just trying to find data that showed what they wanted?
No, they thought that the durables, there was just so much noise in the durables category. That's why they didn't do total consumption. And their definition of non-durables did build on work that Anna Maria Lusardi had done years for other things, because the worry that some of what we're calling non-durables really have a durability component. I mean, that made sense. But then yet in their category, when we started looking at, they had jewelry in there, so it wasn't clear how those categories.
All expenditures MPC, if
With
the
0.
standard error exploded because of the durables, I could see the logic saying,
Yeah,
this is not informative
right.
because that durables
Yeah.
is noisy. Were they really big, the standard errors for the?
Yeah, they were pretty big. They didn't explode.
So like if they go.
So
from
I need to
0.13
remember.
0.4 or?
It has been a while since I've looked at the total. Well,
See where I'm getting at.
yeah. But the point estimate was near 0. And so then we said, well, it's not even worth doing the counterfactual, because if it's 0, it's equal to the data. But I could easily look at it. We're still.
Now, of course, there's what the multiplier is multiplying. If that's not very big.
Yeah.
Okay.
Yeah.
Right.
So, going back to your initial statement, in some way, this is not a robust paper, the Jonathan and co-author, right? So it's not that the macro model, the macro model was the tool to find that it's not robust, but in
Right.
some way, there are other ways you could have done it by redoing the categorization. Is that
Well,
fair?
Well, I mean,
Yeah.
that's the whole idea. We use the macro model because if we want to compare things to aggregates, we need to allow for general equilibrium forces, okay? Because there's a
Right.
possibility of dampening.
So the alternative is that indeed the micro was right and the macro was not taking into
is
account.
not taking into account. So that's why we go, and when I do, well, if I have time on the 2008 rebate, I'll show you that actually the model had an issue too. Because durables were important there. So in each case, we're finding a different interesting answer. This is a little bit more mundane. We have fancy estimates in the 2008, but this is, but as I told you, most of the time, it's not the wrong instruments, it's the devil's in the details. And so that's why, going through replication files is so important, but one has only so much time. And that's why finding this disconnect is a useful thing to figure out where we should look more. The other thing, as Ken mentioned, and then in the process of doing this, we figured out, oh my goodness, the 2001 rebate wasn't a temporary stimulus. It was an initial payment on a 10-year tax cut. If even, forward-looking optimizers, if they don't take into account the government budget constraint, you should have an MPC of, say, approximately 0.33 if they're not Ricardian. Now, if they're full Ricardian consumers, then it should be close to zero. So our conclusion is, well, the micro estimates are not robust, all right? These are not useful estimates for guiding our models. And they're so imprecise that, they're not going to shed light on the macro model. It's not the kind of experiment people want, so we don't even revisit the model. Doesn't mean that the model's right, it's just we don't need to do that.
We're kind of following Ken Judd's thought of using what actually happened, assuming people had perfect foresight, and you've written a couple of papers on that, what actually happened. Another way to divide the consumers up into those who were excessively Ricardian, thinking their taxes were going to go up more, and those who assume that they get no hit because we're all going to be taxes on higher income people, and the like. So that's another way to think about it.
Certainly, our
those taxes are in particular are distortionary,
right,
and cause.
You could,
And since interest on government bonds are taxable to households, but the government doesn't pay taxes, there's this big debate about whether households and the government should be using the same discount rate. Right? So
no, there are
something else you
all
wanna think about.
kinds of things. I mean, so certainly, if we had found robust micro estimates, then that's when we'd really have to start tearing apart the models and saying, all right, this macro model is, too stylized, we need to do something. Okay. So let's see, I think I've already told you everything. Yeah, typically factoring in general equilibrium forces amplifies the problem. And re-examining the micro estimates reveals the non-robustness of those results. And it's not even a good experiment for looking at temporary effects. Right? Let me talk a little bit about the 2008 rebate. That's in this other paper. It was even bigger, and you saw the some of the graphs I'd shown you before. It was passed in February 2008, distributed May through August. The average rebate was $1,000. And these rebates were temporary. So it's a really nice, clean experiment, okay? And this is based on our first paper in this ongoing project, which is the case of the 2008 rebates. I already showed you that counterfactual for the Parker et al. So then we do a GE counterfactual analysis of this rebate, and we learn different things here, okay? We have a two-good, two-agent new Keynesian model, but now we have non-durable and durable goods. And the reason we need to do that is because Parker et al. In that paper found that most of the spending was on durables, particularly motor vehicles. So in our model, we interpret the durable good as motor vehicles. Now, we argue that the high micro MPCs imply implausible macro counterfactuals. We offer a detailed narrative of the events in spring and summer 2008, and we compare the counterfactual path to the professional forecasts and our own forecasting model. Now, few details of the calibration of this particular two-good model. We match micro estimates of durable demand elasticity. This turns out to be absolutely primary importance, okay, and I'll talk about it in a second. We set the fraction of hand-to-mouth households, again, to match the Parker et al. Estimates. We set the motor vehicle MPC at 0.4, that's what he had gotten. In our baseline model, we say, okay, let's let the relative supply curve of durables in terms of non-durables be infinitely elastic and match the size and timing of the rebate. When we do that, you know, our counterfactuals just look crazy, all right? The data is the black line. An MPC, the micro MPC for all of consumption is the blue, the purple, because they had given a range up to even 0.9. And, you know, the way we happen to have graphed this, it's off the graph, which is an effective way of showing how pronounced that V shape is. Okay, how do we reconcile this? Well, several things. First of all, we go back and re-examine the micro estimates in light of the new econometrics, all right? So when they were doing their estimation, they were using state-of-the-art methods. And then this huge big econometric literature came out that figured out that there were all these issues with diff and diff methods, all right? So we used some of theirs, plus we found other sources of biases and use the latest econometric techniques, including our own. And when we correct for those biases, the MPC decreases by 40% or more, all right? So here's a case where they were doing everything right, given the state of knowledge when they wrote that paper. But now we know that what seemed so obvious wasn't. And I don't have time to go into the econometric details. The MPC on non-durables is economically and statistically about equal to 0. So we get those MPC estimates down, but we still have counterfactuals that are somewhat implausible, all right? So this is a case where we actually have to work on both fronts, the estimates and the model. So we modify the macro model to allow for general, or you could almost call it partial equilibrium dampening. What do? We have an upward sloping relative supply curve for motor vehicles. All right, so we actually get crowding out, and this is based on really careful calibration to the leading estimates from elasticities and those sorts of things. We actually, what we get is it results from our model that are consistent with the increase in the relative price of motor vehicles during the period. So the relative price of motor vehicles goes up like 1%. And you see it when that rebate's going out, it goes up. And when we look at narratives of what was going on in the auto industry, there were all kinds of interesting things going on. There were shortages in the smaller cars, which is what most of the rebate recipients wanted. Plus oil prices were going up. So that was also decreasing demand. Now, if we had to have a more complicated consumer problem in this model, because if you just put durables in as usual, you get such high elasticities that you would just have this huge decline in the demand for durables. So we figured out a nice way of putting sort of Calvo adjustment costs that are consistent with the micro estimate. So we spent a lot of time on that one. Happy with, and our model produces that same change in the price. When we do this with this less elastic durable supply, it still has elasticity of 5. All right, so we just went from infinite to 5 here. Then our micro counterfactual using our new micro MPC estimates that, remember, have been reduced with the thing, looks like the blue line, which we think is completely reasonable. We cannot argue that's implausible, but it means that GE MPC, which remember is about equal to an output multiplier, for the 2008 rebates was probably less than 0.2. All right. So a very small multiplier. And guess what? That adds up to the kind of data that you and Marty Feldstein were looking at. So we learned a lot of lessons from this. One is, so heterogeneous agent models are the real hot topic in macro. And what we're arguing here is in some cases, heterogeneous goods can be as important as heterogeneous agents, and particularly when it's durables. Both overall MPC and the distribution of spending across durables versus non-durables really matter for the GE outcome. If we calibrate the MPC to the 0.34, our new estimate, but assume it's a one good non-durable model, we still get implausible estimates because in those cases, you don't have that high intertemporal substitution that you get with durables for the non-durables. So we actually have to make that distinction there with durables. And again, the reconciliation implies a really small multiplier on temporary rebates.
So speaking of intertemporal
Yeah.
substitution and rebates and fiscal policy, so there was a program called Cash for Clunkers.
Yes. Oh, it's huge.
It's a huge effect of people turning in their cars and then demand collapsed 2 quarters later. And I think studies showed it was 10 times the EU carbon trading price for the emissions reductions.
Yep.
But that's something that's also, I think, very informative. It just
Oh, yes.
it's almost perfect, just shifting.
Yeah, we actually have in the 2008 rebate paper, which I've just summarized briefly here. Yeah, we have a graph that shows what was going on with motor vehicle purchases after the rebate when it was supposedly the versus what was going on, with the cash for clunkers. No, there's just a huge difference there. No, absolutely. So third illustration. So this is at a different level of aggregation. This is state level ARA multiplier estimates. So we're moving to 2009 finally. All right. So Gabe Chaudhary-Reich had a wonderful synthesis of the cross-sectional state level ARRA literature. This is in his piece in the AJ Economic Policy. And remember that was passed in 2009. Now, he estimated, he looked at all the different things. People were getting very different answers. Like Dan Wilson would get one, how many jobs created per 100,000. Somebody else would get something else. And we all thought it was because they were using different instruments based on different aspects of the formulas. But what Gabe showed was when you put all this together, when you standardize, again, the devil in the details, exactly how you're estimating things, doing the lags properly, that all the instruments were giving the same answer, all right? So that same answer with that, which I think his good econometric model was about 2 jobs were created for every $100,000 of federal dollars spent in a state. Now, using theoretical insights from Farhi Warning, he argued that the state level multipliers, remember they're only relative multipliers, to go to the national level, we need a macro model. Using the Farhi Warning analysis, he was arguing that the state level multipliers were a lower bound on the aggregate multipliers. Now, he also converted the jobs multiplier to an output multiplier, and it's about equal to an output multiplier of 2. All right, so big multipliers. Now that's very different from the multipliers that I get in aggregate time series data.
Or just taking the average effect of the total spending divided by the change in number of jobs, which would be more like
you'll like the graph here.
Expenses, expensive is the estimate.
So here, creating the macro counterfactual, what we did was we just refined a macro counterfactual. I created actually a 2017 discussion at the Peterson Institute on the new, I forget what the volume was called. We use Chaudhary-Reich's estimated impulse responses of employment using this cross-state variation and his estimates of how much the ARA was spent by December 2010. The reason that he stops in 2010 and that we do is that there was additional stimulus, which then confounds the effects later. So we're going to look at 2010. We created a counterfactual unemployment rate by adding the induced employment to the actual number unemployed. We're implicitly assuming that there's no change in labor force participation, which is, I think, is a reasonable assumption given how little cyclicality there is in labor force participation. So here's what we get. So the unemployment rate, the actual was the green. It got very high. It got to 10%. But if you take his numbers and take his model for taking it to the aggregate level, it implies that had there been no ARA, the unemployment rate would have risen to 15.5% and then stayed up near that level for quite a while. And as I said, we only take it to the end of 2010. That's quite a striking number. Is it plausible? So how to assess plausibility? And this is an illustration how you have to be creative, whatever, for different case studies that you're doing. So what we decided to do was compare the counterfactual rise in unemployment to what happened during the first 2 years of the Great Depression. All right. So what we do is we match up what we call the signature financial crises at the start of both periods. There was a stock market crash of October 1929 and the failure of Lehman Brothers in September 2008. So I'm going to show you a graph of what was going on with the unemployment rate and the counterfactual unemployment rate relative to the month of the crisis, which is month zero. All right. So month zero is October 29 for the Great Depression unemployment rate, and month zero, September 2008 for the ARA. All right, so there's the graph. So the green line is that same actual line, and this shows the change in the unemployment rate relative to that month, okay? So relative to that month, the actual unemployment rate, in 2009, 2010, rose to, I think it was like 4 percentage points, okay?
Peaked at 10-0.
What?
It peaked at.
At 10, yes, but relative to where it was when Lehman, because remember it had been rising since May 2007. Okay, so this is the additional after Lehman Brothers, how much it had risen. The orange line is that same counterfactual that I showed you on the previous graph. Remember, that had gone up to 15%. The rise relative to Lehman Brothers is almost 10 percentage points. The purple line is the actual change in the unemployment from 1929 to 31 using the historical monthly data that Sarah Zuberi and I created for our JPE paper, okay? They're basically going up by the same amount during those first 18 months, according to this. The counterfactual implied by Chaudhary-Reich's estimates versus the actual Great Depression. Okay, so it says that the rise of the unemployment rate during those first 18 months would have been as great as the Great Depression had there been no ARA. All right. Okay. Well, I did show this at this conference where Ben Bernanke
was so modest relative to GDP that it's kind of ridiculous. Yeah.
Well, so policy comparison to the Great Depression. Besides the ARA, the responsive policy was very different across the two periods, okay? We all know during the Great Depression, the Fed began raising the discount rate in 1928 because they were worried about equity prices. They lowered them after the 1929 crash, but then started raising it again in fall 1930 because of the whole gold standard pressures. And then the Fed allowed the nominal money supply to fall. We all read Friedman and Schwartz. In contrast, during the Great Recession, the Fed lowered the federal funds rate, starting a year before Lehman. The Fed drove the funds rate to zero and then implemented new methods to provide liquidity and stimulus. There was TARP. The money supply increased dramatically. So what we conclude is the belief that without the ARA, the Great Recession unemployment rate would have risen by as much as the first, 18 months of the Great Depression requires that one also believe that monetary policy doesn't matter, because we're talking about dramatically bad monetary policy. And then we're talking about a chairman of the Federal Reserve during the Great Recession who apologized to Milton Friedman for that bad monetary policy on the part of the Fed, Ben Bernanke, during that famous quote. who did everything possible to prevent a Great Depression. And yet that counterfactual suggests that the unemployment rate would have gone up the same amount.
I mean, related point, I asked Bernanke this once at a conference and he said, yes. Would they have been more aggressive with unconventional policy if it hadn't been for the ARA? And he said, yes.
Yeah.
Yeah. So and again,
Exactly.
that's controversial whether those unconventional monetary policies have
Yes.
big real effects, but that
Right.
at least would reinforce this point.
Yes. Oh, that's good. So how do we reconcile the state estimates with the macro counterfactual? Well, in my Journal of Economic Perspectives paper, I argued that the state level estimates are not nationally representative and therefore shouldn't be directly aggregated up. So those studies use per capita variables. So each state is weighted equally. That means that North Dakota with less than 700,000 people gets the same weight as California with 36 million. Okay, if there are heterogeneous treatment effects, that could be putting too much weight on North Dakota. Most studies also don't take into account the possibility of induced state government spending as a result of those transfers from the federal government. But then there's a study, somehow it didn't get into these slides. Leduc and Wilson argued that there was induced state spending. So what I did in that paper was, first of all, I just replicated Gabe Chowderoy-Reich's estimates with his wonderful replication files. As I said, the fiscal people almost always have great replication files. Then all I do is just reweight and do population weighted estimates to see what it looks like. And it drops from 2 to 1.15. The standard error goes up there. Then,
How about wealth weighted?
well, yeah, whatever weighting you
Yeah.
want. The third column also does the population weighting, but takes into account total spending, right? Because if you're talking about a multiplier, you want to count any induced spending by state and local as well. So I take federal and state and local, and lo and behold, the multiplier drops to 0.9, or the jobs created, which is basically the multiplier. So a rough calculation, we want to do this more carefully, suggests that the counterfactual from using the 0.9 but using the Farhi-Werning kind of theoretical modeling for aggregating up suggests that the unemployment rate would have risen to about 12% with no ARA. That's very preliminary. Still significant, all right, but not 15.5%. And so we're currently looking at re-estimating the full path with this. Yeah.
May or may not be useful. So there was an ex ante and then real-time set of forecasts being done by Bernstein and Romer, et cetera, when all this went into effect. And whatever the effect was in the first 2 years, the gigantic difference is how weak the recovery was, the weakest since World War II. We can argue what the argument thinks about that. But if you look at the difference in job years between their estimates and the actual, it turned out to be 20 million. And it's mostly that they assume the economy gets back to 5% a lot more quickly. So there's kind of a flip side of this, and maybe what was done then affected the flip side, and you could argue monetary policy change. We had, QE, 1-2, twist, et cetera, all this sort of stuff. But it seems that's kind of, the whole story should involve something about that as well, it seems to me.
Right.
And the whole story in evaluating policy, dealing with recession, should deal with the aftermath. I mean, there's this kind of fun paper by Harold Uhlig in the AER that's looking at the present value of expenditure multipliers as they merge into a growth model and have to deal with the higher taxes later.
Right.
If we're not in a,
It's negative.
and it turns out it's negative.
Yep. No, I know that.
So, and then they're all, Michael Woodford, it depends on what people expect about taxes, and it could be negative anyway if they, given what when they expect taxes to rise and how much, et cetera. So it seems to me that this is great, but I'd like to hear the other side of this at some point from Valérie.
On the slow recovery?
Yeah, or what happens after the initial.
Well,
if you're focused, I think rightly for the time being on dealing with on the initial stuff, but there's an aftermath, and the aftermath is not probably not independent of what
Right.
policies were
Well,
affected to do this.
So I can advertise my co-author Johannes Wieland's Econometrica paper and AR Insights paper with Alistair Mackay that talk about, so our durables model comes from their paper, because what they find is a lot of those policies just pull demand forward. And then you get the dip afterwards. Yeah, so I can highly recommend those papers because they're making exactly the kind of point you're making. And as you say, Harold Uhlig's paper about they need to raise taxes, and no, it's not going to be lump sum. It's going to be distortionary, and then you get those negative effects. No, absolutely. And yeah, so our idea is, we've got these great new tools in our box. They're not useless tools. They're useful, but it's particularly nice to have macroeconomists using them because we tend to think big. And looking at what's going on in the aggregate and making sure that what those micro estimates are doing along with the macro model is adding up to what we see in the aggregate, or is it producing implausible counterfactuals? So we can assess that plausibility. I've illustrated it using 3 examples from our work. And as you see, the search for reconciliation can lead to new insights about things you need to do with the model, such as durables can be really important, say in a model, on better estimates of the micro parameters. And you can think about using this for natural experiments in other countries, as well as for other questions. And you can even think of partial equilibrium questions like industry equilibrium. So
Now, some of these observations are obvious, like it's dumb to talk about ARRA without talking about monetary policy. That's hardly a big insight. Now, by the way, regarding 2008 and thereafter, have you seen Casey Mulligan's book on redistribution recession, I think is the name? Because he goes through a lot of micro style facts that talk about the impact of various micro things on unemployment, et cetera. So that bears something you should look at. Now, I'm trying to think of, why is GE different than the micro stuff? And see, the thing is, your micro regressions and like I said, the Michelangeli and somebody paper, this one I'm more familiar with, basically they kind of assume that expectations about the future are unaffected by any policy. Now, when you put general equilibrium in your general equilibrium thing, what you're really doing then is replacing this no change in expectations with the general equilibrium change under perfect foresight. You said you're doing shooting, so you're doing perfect foresight.
Yes.
And so now I guess my question is, why would I trust a model that assumes that people have perfect foresight over a model that assumes people basically don't think that there's going to be much change in anything? So the way to go, I would think, is stay with sort of the micro data kind of thing, but then actually try to ferret out what are the expectations, because this MPC thing is really talking about how individuals react to a change in policy. And that's how they react to the rebate today and how they react to the changes in future things, interest rates, tax rates, et cetera. And that's what goes into those individual decisions. And the perfect foresight general equilibrium way to deal with this expectation question is unrealistic in many ways. And like, I doubt many people, in particular people who don't have a whole lot of money, really can solve through in their mind Ricardian equivalence kinds of models.
So remember, our hand-to-mouth consumers
I know.
are pretty myopic. So
Yeah,
so
course,
they don't have.
but I don't think the thing is that the number of people that are hand to mouth is not fixed over time. Sometimes people are in a hand to mouth state and then they leave the hand to mouth state. So you don't want the analysis to revolve around a large fraction of people constantly being hand to mouth. So again, that's the expectations. And so that's that's the difference, right, between the micro and the GE is that you pin down, you assume that the expectations are that determined by a perfect foresight equilibrium. That seems to be the difference between the micro and the macro.
Well, no, that's not the only difference. It's
Well,
also
the-
the standard New Keynesian amplification.
But yeah, well, okay, no, by a general
I
equilibrium
think we
thing.
want to have some other questions before we go.
Yeah,
too, so.
I have a couple of other observations and if they're useful. And one question and one kind of fun anecdote about people wanting details. So the observations are that there's a lot of literature about federal spending offsetting state and local spending.
Mhm.
Now, the argument during the rebates and well, not so much the rebates, but the AARA and all this sort of stuff, is because of 44 of the 50 states have balanced budget requirements. They're not going to be able to respond, and their revenues are going to fall, and then we're going to have to make them whole, or we're going to have to offset that somehow with greater spending or sending them resources. That, of course, seems to have not happened this last time during COVID, when they basically just saved they didn't need the money. But that's something that's kind of worth thinking about because state and local government spending and taxes in aggregate are 60–70% of the federal level. The hand-to-mouth consumers, it's not so much the percentage of consumers as the percentage of consumption, right?
Yes.
That's you're interested in. So I was wondering, maybe you or Pete, is there any recent studies about that? I remember Hall in Michigan had this paper that it was 75% was longer term and only a quarter was had. There's more research on that? Anybody have any? Is there a current going conventional wisdom among macroeconomists about what that percentage is, or
Okay.
what percentage
Yeah.
of consumption is not hand to mouth or conversely is hand to mouth?
Of total consent. So Jonathan Parker and several others have recent papers trying to look at who are the hand to mouth, and then there's another one I'm trying to remember.
Bills and
Bill-
Aguilar, Karina Bauer.
Yes, bills. So there are some recent. But do you remember what the answer is? Say
Their
for the bills.
answer is it's not low liquidity people.
Yeah.
It's like I'm trying to remember what the category was that they thought was distinguishing it. Yeah, I thought it was something like how permanent their labor supply is or something. It was some unusual thing that was indicating whether they're likely to be hand to mouth.
I think the casual commentary was people were shocked. Shocked at how many people seemed to have so little in reserve when they got laid off. So that's, I think, some commentary on that.
Right.
And then Tom Sargent spent more time than he probably wanted to trying to convince me there was a large difference depending on whether there are really large changes to anything. And since one of the debates has been, I think, with what I think I understand probably erroneously, is that some of these were just way too small. There was an argument from some
Rebates.
Economists. Well, ARA was way too. Paul Krugman, if
Paul
you want to
Krugman
take
thought it
someone,
was too
former
small.
economist, you can take Paul
Yeah.
Krugman. But well, I think that's a fair point. In any event, so the question is, if it had been 4 times as large, would that have made? And Tom seemed to be big on regime shifts, and he ends up 4 big inflations and all this sort of stuff. So he had this kind of notion about that. But is there any? And then we interviewed somebody for a job market paper. His name escapes me. We didn't wind up hiring him, but had done some empirical work on this. Was there any recent work on anything like that among empirical macroeconomists?
Yeah, on that one. Well, there's nice theoretical work starting with Kaplan and Violante and Econometrica, where the size does matter, and the MPC is actually bigger for the smaller size, because if that rebate is that temporary income is bigger, then you actually pay the fixed cost of adjusting your portfolio, and so your MPC will be smaller. So which is which counters Paul Krugman's argument, who was saying, oh, we just need it to be bigger. Well, not necessarily. It could have actually had less impact.
I'll take a look, and that's what I was kind of looking
Yeah.
for. Just one cute anecdote. So when I was CA chair, we had a brief mild recession. And at the time, Senior Bush being a Republican, the Democrats had like 58 senators and 275 congressmen. So we didn't want to do anything, send anything to Capitol Hill because we didn't, first of all, I didn't believe that spending would do a whole bunch of good for a short, brief recession, a mild recession. But in any event, and John Taylor, I think, believed that too. I think that what we designed was a change in withholding. So we didn't need the Congress to go along.
Yeah.
And we announced this because people were being over withheld, and over time, more over withheld. And so we changed the withholding schedule, which moves some disposable income forward. And I can't tell you how much time I spent responding to inquiries from every economist in Wall Street, all the macro, everybody in the blue chip was calling and saying, what's the exact details, et cetera, because they were trying to get the details into their models. So there are some people, maybe not the way you think of it, but there are some people who actually obsess over things like that. I was kind of shocked at that.
No,
I
which
thought it
is,
would be very small, but he could say he did
Right.
something. That was the basic idea, it was to minimize the damage of anything he did.
yeah.
So
No, that's it. The fact that we don't do the small details, doesn't mean we don't think they're important. It's just we're trying to do a sort of simple, transparent, stylized model to make the point, and then it tells us, which cases where we need to go into the details
and
more.
what parameters are important. et cetera,
Exactly.
sure.
Valerie, I just wanted to say, I learned a lot.
Oh,
It was a really lovely presentation, but if you were to testify before Congress, Senate, President, privately, CEA chair, whoever, would your advice about doing a stimulus change now after this research, and what would it be?
Well, I think, you want to get better estimates. If you can get them to spend it mostly on non-durables, you'll get a bigger aggregate effect because you don't get that relative durables price kind of eating up the effect. Yeah, but you can't do that. So you could think about
I'm just wondering if you would
targeting.
be in the
Yeah.
room and say, don't do a stimulus.
Well, you have to be careful. I'm not seeing a lot of bang for the buck.
Mm-hmm.
Now, I think that there are few cases where you might want to give out checks. So certainly during the lockdowns of COVID, those were like life preservers simply because people.
Yeah, there's a strong humanitarian case, whatever the economics were.
Yeah.
Exactly. And politically, the fact that the government was not letting you go to work and do all of these things, it was incumbent on them to, try to do that. But all of those follow-up ones, the one in December 2020 and then the one in March 2021, just did not make any sense to me.
Well, it really made no sense. It's about a year ago, I got a check from the state of California. Now, that was totally absurd.
Yeah,
That
but
was just
it's
nuts.
because their schools are already so well funded. They have sky-high test scores. So what else are they going to do with their
I
money?
know, I told Teresa that can't be true.
Yeah.
But no, it was true. We get a check
Yeah.
from California.
Thanks again.
All right, thanks.
Thank you very much.